Is your financial advisor legally required to act in your best interest? Go ahead, think about it. You probably said yes. And you're not alone. Surveys show that 76% of Americans believe their financial advisor has a legal duty to put their interests first. They're wrong. And that misunderstanding right there is costing American families $17 billion every single year. Not because advisors are bad people, not because the market crashed, not because of inflation or bad luck. $17 billion a year is being quietly, legally, systematically transferred out of your retirement accounts and into the pockets of financial institutions using mechanisms so well hidden that most people will go their entire lives never knowing it happened to them. In this video, we're going to pull back the curtain on how the financial advisory industry actually works in the United States. We're going to show you the two-hat illusion that lets your advisor legally switch their ethical standards mid-meeting. We're going to run the math on a fee that looks like 1%, but costs you over $2 million. We're going to walk through real SEC enforcement cases, JPMorgan, Wells Fargo, Merrill Lynch, where clients had their cash silently drained through a mechanism most people have never heard of. And then, at the end, we're going to give you a 10-minute protection checklist so you can find out tonight exactly which legal standard governs your advisor and what questions to ask to protect yourself. Here's the reality. The financial services industry isn't broken. It's working exactly as it was designed to, just not for you. Let's get into it. Let's start with the most important thing you were never taught. In the United States, there are two completely different legal standards that govern financial professionals, and the industry has spent decades making sure you can't tell them apart. Standard number one is called the fiduciary standard. This applies to registered investment advisors, RIAs. Under this standard, the advisor has what's called a duty of care and a duty of loyalty. Those aren't buzzwords. They are legal obligations enforceable by the SEC. A fiduciary must give you advice that is in your best interest at all times, not just when it's convenient, not just during the sale, always. Standard number two is called Regulation Best Interest, or Reg BI. This is what governs most stockbrokers and broker-dealers. The SEC upgraded this from the old suitability standard back in 2020, and on the surface, it sounds similar. It says brokers must act in the customer's best interest. But here's what the fine print says that the industry doesn't advertise. Reg BI only applies at the exact moment a transaction is recommended. The second the sale is made, the obligation ends. There's no ongoing duty to monitor your account, no requirement to check back in, no legal responsibility for what happens next. And here's the other thing. Under Reg BI, commissions are still perfectly legal. The broker can recommend a product that pays them a higher commission than a cheaper alternative, as long as they disclose it, usually buried in a standardized form most people never read. Now, here's where it gets genuinely disturbing. The majority of financial professionals in America are what's called dual registrants. Over 51% of registered financial professionals, that's more than 331,000 people, hold both an advisory credential and a broker-dealer credential simultaneously. And what that means is they can legally switch between these two standards depending on what they're doing at any given moment. Think about what that looks like in a real meeting. Your advisor sits down with you. They put together a comprehensive financial plan acting as a fiduciary. Then, in the same meeting, they pivot to recommend a specific annuity product. At that exact moment, they've legally switched hats. They're now a broker. They're no longer held to the fiduciary standard. They can earn a 6% commission on that annuity, and it is completely legal. And here's the kicker. There's no bell that goes off. There's no disclosure that says, we just switched standards. The title on their business card, financial advisor, wealth manager, financial consultant, none of those titles are legally defined. There is no federal restriction on who can use them. A commission-based salesperson and a true fiduciary can have the exact same title. 76% of Americans think their advisor is required to act in their best interests. Most of them are talking to someone who legally is not. But the title is just the beginning. Because the next layer, the math, is where things get genuinely jaw-dropping. This is the section most people skip over because it sounds boring. 1%. It's just a fee. How bad can it be? I want you to stay with me for 2 minutes of math, because what you're about to see changes the way you think about fees permanently. Here's a scenario. You have $1.5 million saved for retirement. Your advisor charges the industry standard 1% AUM fee assets under management. The market returns 7% gross per year over 30 years. The AUM fee doesn't just take 1% of your gains each year. It takes 1% of your entire balance. And because it's deducted directly from the portfolio every year, it shrinks the base that compounds in future years. Every dollar extracted in fees is a dollar that can never grow again. After 30 years with the 1% AUM fee, $8,446,182. Now run the same scenario with a flat subscription fee, $725 a month, $8,700 a year paid from cash flow outside the portfolio. So the full balance keeps compounding at 7%. After 30 years with the flat fee, $10,539,047, the fee difference, $2,092,865. On a $3 million starting portfolio, the AUM model costs you over $5 million compared to the flat fee alternative. Over the same 3-0-year period, same returns, same advice quality, just a different fee structure. And here's the psychological trick that makes this work. The AUM fee is never deducted from your bank account. You never write a check. It comes out of your portfolio automatically every quarter. And because of that, a huge percentage of retail investors with AUM advisors genuinely believe they pay nothing for their advisor's services. The industry calls this payment decoupling. You never feel the money leave, and so you never question it. But the AUM model has a second conflict built into it that's just as insidious. Think about what an AUM advisor gets paid on. Everything in your managed portfolio. Now think about what an AUM advisor gets paid less on every time you make a completely rational financial decision. Paying off your mortgage, your investable assets go down, pay cut. Putting money into your private business, pay cut. Gifting money to your kids or grandkids, pay cut. Moving to a lower cost index fund strategy, pay cut. The AUM model creates a direct financial incentive for your advisor to keep as much money as possible inside their managed accounts, even when other uses of that money would genuinely be better for you. Most people stop here. They hear the fee math and think the solution is just to find a cheaper advisor. But what we haven't talked about yet is the thing that even sophisticated investors rarely see coming. And it might be happening inside your account right now. This is the section that, in my opinion, should be national news, but somehow isn't. Here's how it works. When you have an investment account at a major brokerage, you always have some cash sitting on the sidelines, money waiting to be invested, dividends that haven't been reinvested, proceeds from a recent sale. That cash has to go somewhere. So most brokerages have what's called a cash sweep program. They automatically move your uninvested cash into an interest-bearing vehicle overnight. Sounds reasonable. Here's where it turns predatory. Major institutions, Wells Fargo, Merrill Lynch, JPMorgan, designate their own affiliated banks as the default destination for your swept cash. And those affiliated banks set the interest rate, they pay clients at whatever they want. How low? As of recent regulatory findings, 0.02% to 0.05% annually. Meanwhile, those same banks take your cash and lend it out, or buy short-term securities yielding 4% to 5%. They pocket the entire spread as profit. And here's a part that should make you genuinely angry. While your cash is earning essentially zero, your advisor is still charging you the 1% AUM fee on that cash balance. You're paying 1% in advisory fees on money that is guaranteed to lose real value every single year. This isn't a hypothetical. On the 17th of January, 2025, the SEC charged Wells Fargo and Merrill Lynch for exactly this practice. Wells Fargo had been routing client cash into low-yielding affiliated bank deposits since 2019. Their client yields 0.02% to 0.05%. The gap between those rates and available alternatives, like money market funds, up to 5%. In their own conflict disclosures, Wells Fargo explicitly stated that the firm does not have any duty to monitor the swept cash or make recommendations about it, while simultaneously charging asset-based fees on those same balances. SEC fine, $35 million. Merrill Lynch restricted the vast majority of its advisory clients to the Merrill Lynch Bank Deposit Program, an affiliated bank that generated massive interest spreads for its parent, Bank of America. Client yields lag market rates by up to 4%. The firm never built compliance systems to evaluate whether the default rates were in clients' best interests. SEC fine, $25 million. And those fines, as large as they sound, they're a rounding error compared to the billions earned in net interest margin on swept client cash. But this story isn't over. Because while the SEC resolved its cases administratively, over 30 class action lawsuits have now been filed against JPMorgan, Wells Fargo, Morgan Stanley, UBS, LPL Financial, Ameriprise, and others. Federal courts have systematically denied motions to dismiss across almost every case. The legal reckoning for what Wall Street did with client cash is just beginning. Now, let's talk about the people who were supposed to catch all of this. Because the data on who's actually in this industry is one of the most underreported stories in personal finance. In 2019, 3 economists at the National Bureau of Economic Research published a landmark study. They analyzed the records of hundreds of thousands of US financial advisors going back years. Here's what they found. 7% of all registered financial advisors in the United States have a formal misconduct record. That's roughly 1 inch every 14 financial advisors. Not suspicions, not rumors. Documented formal disciplinary actions. At several of the country's largest firms, firms like Oppenheimer & Co., Wells Fargo Advisors, First Allied Securities, the misconduct rate exceeds 15%. That's more than 1 inch 6 advisors at those specific institutions. But here's the statistic that I think is the most telling of all. When a financial advisor is caught and fired for misconduct, 44% of them are rehired by another firm within 12 months. Nearly half. Rehired within a year. And once rehired, past offenders are 5 times more likely to engage in new misconduct than advisors with clean records. Why does this happen? Because the financial industry's internal labor market has a well-documented tolerance for repeat offenders. Firms facing a shortage of experienced advisors with established client books actively recruit disciplined advisors from competitors. The regulatory stigma fades quickly. And because misconduct records are kept in the FINRA BrokerCheck database, which most consumers have never heard of, let alone checked the predatory advisor, simply sets up shop with a new business card. The researchers also found that misconduct is not randomly distributed across the country. It's 19% higher in counties with elderly, wealthy, and less educated populations. In specific counties in Florida and California, approximately 1 in 5 financial advisors has a formal misconduct history. These aren't random bad apples. The data shows a pattern of geographic targeting of vulnerable, high net worth populations. And there's a recent study that makes this even darker. Researchers looking at the period after local newspapers closed in counties across the United States found that financial advisor misconduct in those counties increased by 19.28% following the closure. When local investigative journalism disappears, the perceived social and professional cost of getting caught goes down and misconduct goes up. The system has a structural tolerance for predatory behavior, which means the last line of defense is you. Here's exactly what to do. You don't need to become a regulatory expert. You need 4 things. This will take you about 10 minutes. Step 1, run their name through BrokerCheck. Go to brokercheck.finra.org. Type in your advisor's name. This database shows you every registered broker-dealer in the United States, their employment history, any formal complaints, regulatory actions, and terminations. If your advisor has a misconduct record, it shows up here. Step 2, look them up on the SEC's IAPD. Go to advisorinfo.sec.gov, the Investment Advisor Public Disclosure Database. This is where registered investment advisors are listed. If your advisor is a pure RIA, they'll be here and their Form ADV will be attached. That document tells you exactly how they're compensated and what conflicts of interest they've disclosed. Step 3, pull their Form CRS. Every financial professional registered with the SEC is required to give you a Client Relationship Summary Form CRS. It's a short, standardized document, usually 2 pages, that describes the type of services offered, the fees, and whether the firm has any legal or disciplinary history. Most people have never seen it. Ask for it. Step 4, ask the one question that cuts through everything. When you're sitting across from any financial professional, ask them this, word for word. Are you a fiduciary? And are you acting as a fiduciary in every aspect of our relationship, including when you recommend specific products? A dual registrant operating primarily as a broker will be unable to answer yes to the second part of that question. A true fee-only RIA fiduciary can answer yes without hesitation. If they hedge, if they say it depends, if they pivot to talking about how much they care about their clients, you have your answer. One more thing. If your advisor uses the AUM model, go back and ask them to show you exactly how much in dollar terms you paid in advisory fees last year, not the percentage, the dollar amount. Most advisors will show you 1% and hope you never do the multiplication. When you see the actual number and then project it forward 30 years using what we showed you today, you'll have a much clearer picture of what that relationship is actually costing you. Let me bring this back to where we started. $17 billion a year. That's not theft in the dark alley sense. That's wealth transferred legally, structurally, quietly through a system built on a regulatory gap most Americans don't know exists. We walk through how dual registrants can legally switch ethical standards mid-meeting and how the titles on their business cards tell you nothing about which standard applies. We showed you how a 1% fee deducted internally from a compounding portfolio, it doesn't just take 1% from you. It costs a $1.5 million portfolio over $2 million across a 30-year retirement. We exposed the cash sweep arbitrage that had your uninvested cash earning 0.02% while your brokerage pocketed a 5% spread, and that the SEC had to fine Wells Fargo and Merrill Lynch to make it stop. We showed you that nearly half of advisors fired for misconduct are rehired within a year, and that predatory behavior is highest in counties with wealthy, elderly populations. And we gave you the 4 tools: BrokerCheck, IAPD, Form CRS, and 1 direct question to protect yourself in the next 10 minutes. Here's the thing I want to leave you with. The financial advisory industry has deeply good people in it. There are genuine fiduciaries who work tirelessly for their clients. The problem isn't every advisor. The problem is a regulatory structure that makes it impossible for most consumers to tell the difference between someone who is legally bound to protect them and someone who is legally permitted to sell to them. Now you know the difference. The next step is up to you. If this video changed the way you think about your financial relationship, share it with someone you care about. And if you want to go deeper on how to audit your own investment fees, that video is right here.